All right, ladies and gentlemen, welcome to episode number 6 of Be the Bank, the best place on YouTube to learn about the distressed secondary mortgage market. I'm your host, Robert Heitha, and this week is a little bit of redemption because last week, if you watched episode number 5, our intro scene, our outro scene, unfortunately had no audio. We did have some great content. Last week was all about first versus second liens. We also gave away our first giveaway freebie, a download for an internal rate of return calculator. So be sure to check out episode 5. You just might want to skip over the intro and the conclusion since we didn't have any audio. This time around, we made sure that that's working great. So before we get into it, let's do a little bit of housekeeping, of course, and thank the 11 investors who have signed up for our non-disclosure agreement and access to mortgage note investments going forward in this past. Actually, it's been 2 weeks. I shouted out a bunch of these people last week, but there was no audio. So I got to give you guys the proper respect here. Thank you for Iris, Amitesh, Brendan, John, Eleanor, Alex, EC, Anasi, Monty, Katina, and Teresa. Thank you so much, guys, for signing up on the FIXnotes website. We're in between offerings right now, but you should have some upcoming portfolios available for you to take a look at very soon. But without further ado, let's get into the show. All right. So this week's episode, we are talking about bankruptcy. It's a very exciting show, and we've got a lot to talk about. So I'm glad you're here, and I think I'm already making technical issues here considering there's no audio coming out of my presentation, which is no good. I don't know why that's happening. In any case, though, we're going to make the best of it and start out with overview of the industry. But before we do that, let me just quickly point your attention to FIXnotes.com. If you are looking for interesting information about the mortgage note industry, you can find it over at FIXnotes.com/learn. This is like a 30,000 word guide I wrote in like 2 weeks straight. I just crammed everything I know into this course. It's 100% free, so I encourage you to go check that out on the FIXnotes website. It's broken up into a bunch of different modules. It's organized in a way that makes it very easy, digestible to understand and learn. So if you're just watching our show for the first time, please get over on FIXnotes.com and increase your education with some really specific, actionable content over there. Lots to learn. And of course, industry overview starts with the news of the industry. So if you go over to FIXnotes.com/news, we've got an aggregator set up to generate industry source content from all over the industry. So check that out. We've got a news syndicator. We're not going to go over any specific stories today, but I did want to mention that CoreLogic, one of our vendors, which we've actually added to our tech overview screen, is experiencing somewhat of a takeover bid situation. And it's kind of an interesting thing to follow because as we leverage CoreLogic's products for our due diligence and research capabilities, a takeover of the publicly traded company maybe would affect some of the offerings that they have. So we'll keep an eye on that. But next week we will be talking more in detail about CoreLogic. So that'll be a great thing to touch next week. Now, we always talk about market pricing. We kind of just highlight this, and it's not going to be much of a change from previous weeks. Since we're still in the third quarter here, and pricing is kind of stabilizing from some of the COVID fallout, and also we see the real estate markets really heating up. 50% of all home transactions right now are in bidding wars, which is very interesting. I think most of that is driven by the low interest rate environment, which is certainly affecting housing prices across the country, which I think will be a positive development for both performing and non-performing note values as equity increases. But we'll keep following that and let you know as things change there. Okay, so I wanted to just highlight this slide since we talked about it last week, junior versus senior liens and why I prefer second position liens. We went into more detail in episode 5, but I included this slide here just so if you missed last week, and I don't want you to go back and see my lack of audio in the intro and the conclusion, so we'll just cover it here. Senior liens are more expensive due diligence There also can be wiped by senior position debts, especially in super lien states. They're property-centric resolutions typically, where you have to do things like put a forced place insurance policy to protect your investment when the borrower is not paying for property insurance. They're more expensive typically. You don't get as great of a discount in senior liens, and you're often left with lower quality collateral. In our most previous listing of assets for sale, the average fair market value for the first liens was $96,000, and the average fair market value for the second liens was $347,000. So you're dealing with higher quality collateral when you buy junior liens. The due diligence expense is cheaper at $50 to $200. They can also be wiped by senior position liens, but as opposed to a senior lien that can be wiped by taxes or a homeowners association, a junior lien kind of has a senior lien as a first line of defense. So you're able to kind of leverage some of the senior liens research capabilities and, for example, they're escrowing taxes and insurance, and you can use that to your advantage as a second lien holder. You're kind of behind the block and the tackle from the first position. There are also borrower-centric resolutions. So typically when you're dealing with second liens, you're able to get a lot more workouts done just from your desk. With first liens, you need boots on the ground, you need people reviewing the property values, and it becomes a little bit more of a team effort, I think you could say. In junior liens, you can really manage it with just your servicing company and maybe an outsourced legal team. But when you're buying first, you need realtors, you need more involved attorney relationships because you might go through more foreclosure processes, and door knockers and rehab companies sometimes. So there's a lot more involved in senior liens. Junior liens are greater discounts. It's easier to diversify. So I prefer juniors over seniors. We actually have some follow-up questions that I received from one of our viewers last week that we're going to touch, I think next week in the second, and you'll see in the end of this episode, we had our first 15-minute free consultation for one of you guys as a giveaway. So we'll probably cover some follow-up questions to this slide in next week's episode. Okay, this is another slide that I promised we would drill into in future episodes, and that's what we're doing today. We're going to drill into bankruptcy specifically. So bankruptcy is a very important thing for note investors to understand because it is maybe one of the most, when it happens, it's probably the most important thing you have to review. Not every account goes through bankruptcy, but those that do, you really have a better picture of that borrower's situation. A bankruptcy, the first filing is called the voluntary petition, and that tells us so much about a borrower that you might not otherwise know. So let's go over the bankruptcy overview as it pertains to Chapter 7 and Chapter 13 bankruptcies. So Chapter 7s are what's called a liquidation of debt, and that means that they are selling assets to liquidate their estate and to basically free up capital to pay these creditors off. So there is a exemption for your homestead, whereas if you have less than $24,000 of equity above your first and your second position mortgage, and if there's any other liens on the property, if you have this excess equity, then that property could be liquidated in the bankruptcy. However, if you have less than that $24,000, it's specifically $23,675 of equity, then you can remain in that home as an exempt asset. That's your homestead, and because you're pretty tight on the equity, the courts will not take that property away from you as a borrower. Your income as a Chapter 7 filer must be low enough to pass a means test. Chapter 13 bankruptcies are for higher earning borrowers. Chapter 7 can be for lower earning. And it's typically 3 to 5 months to discharge. 7s are a lot quicker than 13s because you don't have to continue an entire bankruptcy plan. A Chapter 7, you're liquidating the assets, and that can fulfill the requirements of the plan within 3 to 5 months typically. Now, the trustee is selling all those non-exempt properties to pay off all the creditors. So you're going to see in your voluntary petition schedules which detail the value of the assets and the liens that need to be addressed on each of those assets. So let's get into Chapter 13s and how they're different than Chapter 7. So Chapter 13 is a reorganization of debt. And that means that the assets aren't necessarily going to be sold, but there is going to be some situations where liens are going to be stripped or crammed down on specific assets that the borrower owns. So In Chapter 13, you don't qualify unless you have less than $394,000 of unsecured debt or $1.18 million of secured debt. So for most borrowers, that threshold, that's pretty high. So most borrowers would qualify for the 13. And it's discharged when the plan payments are complete. So that's the biggest difference between 7 and 13. A 13 is not discharged until the borrower fulfills a plan. And at minimum, that's going to be like a 3-year plan, as opposed to 3 months that 7 could turn around so quickly. BK plan in Chapter 13 takes some time, and that borrower is going to be making payments to the trustee, who then distributes that payment to all of the creditors who are on the schedules. And the risk in Chapter 13 as a lien holder, especially as a second position lien holder, and this is one downside to junior liens that is important to drill into today, is that a bankruptcy Chapter 13 can remove a junior lien through a lien strip or a cram down. And what we'll see, and we'll review this in a case study coming up, is that in your voluntary petition, there's something called a Schedule D. And the Schedule D reviews secured creditors, secured liens. And in that schedule, it shows the value of the property, and it shows all the liens that are secured by that property. If the value of the liens, the total amount that's owed, is more than the value of the property, then these junior liens who are wholly unsecured, is the word, a wholly unsecured junior can be lien stripped. Or if it's partly unsecured, it can be crammed down, which essentially means that your principal balance goes from $100,000 to $50,000 if there's $50,000 of equity in that. $50,000 that's underwater just gets crammed down and written off. Now the big caveat here is that it doesn't become effective until the discharge. So in Chapter 13, because that discharge takes 3 to 5 years, a junior lien holder is kind of in limbo for some of that time. They don't know if it's going to be stripped or not. If you've already done everything you can to dispute the property value, if you think the property is worth more, and to make sure you review the other parts of the plan, it's a waiting game. And if that borrower does prove that your lien should be crammed down or stripped, then it's not going to effectuate officially until the discharge. And we're going to learn this more in the case study as well, but 33% of Chapter 13s do make it that far. That's the general consensus. About 2/3 of Chapter 13 bankruptcies do not get all the way to the end and complete their Chapter 13 plans. So all of the potential cram downs and lien strips that happen on the 2/3 of bankruptcies that are not completed, those liens are still they're still valid liens at the end of the bankruptcy. So that's an important thing to understand, because just because the voluntary petition shows that a lien is wholly unsecured doesn't mean that lien is stripped until the borrower is successful in their bankruptcy. And since these take a while, it can lead to a positive equity situation during the course of that plan if the borrower is dismissed, which is the opposite of discharged, and maybe the property value has increased. Then next time they refile that bankruptcy, you might be in a better equity position as a junior lien holder. So bankruptcy is part of the technology that we use, because we use I guess it's not software, but we use a government database called Pacer. And we have a lot of services that we use. We cover this slide every single week, but I've actually added one thing this week, which is exciting, and that is CoreLogic, right smack dab in the middle. I'm kind of blocking the screen here. Let me pop over. Google Sheets, of course, I was blocking, is our equivalent to Excel when we want to use more tech-enabled shareable spreadsheets. There's so much stuff here that I can't cover it all, but we always touch on at least one of these things every week. And this week, we're talking about Pacer. So this is a web service, not really software. And the BK Case Locator is what we want to focus on today, because this tool, and I think if I just click on Pacer, it'll take me over to it. Actually, I already queued it up, so let's just go over here. This is called the Pacer Case Locator, and you need to sign up for a Pacer account, pacer.gov, in order to, and I'll just type this in here so you don't get confused, but pacer.gov is the main site. Oops. Okay, so you go to pacer.gov, you sign up for an account, it's free, but you do need to put in credit card details, because searching and downloading files does cost, I think, 10 cents per page. Totally worth the expense. A bankruptcy, as far as borrower information is concerned, is the most up-to-date data, the most vetted information you can find on a borrower, and it gives you a real picture into the borrower's finances. These schedules that we'll see in the voluntary petition are super important to be able to understand that borrower's specific financial situation and how you can move forward with a resolution as a lien holder. So first you use this screen. You can search by social, you can search by name. If you have the case number, you can search by the case number. Once you click through these, you'll have to enter the information or enter the name, and then that will take you to this screen. Oh, sorry. That will take you to a different screen that I can't show you because it's personally identifiable borrower information. But what we can do, just to give you an example of that, let's just put in a common name, John Smith. Let's see all of the John Smiths who filed bankruptcy. So there's this huge list, maximum limit exceeded. So this isn't anything confidential since it's a bunch of anonymous names here. But this would show you the bankruptcy accounts or other court filings on your subject borrower. So when you click through one of these cases, you'll get to a screen like this. Now this screen is kind of your dashboard into a bankruptcy filing. And the main place I like to look is history and documents, because that's where you're going to find the voluntary petition, the bankruptcy plan, any motions that are filed. That's really what you need to understand to keep in track of all of the ongoing developments of a BK plan, the history and the documents. So I'm not going to click this either because this is a specific borrower, and once I click that, it'll show their name at the top. So I actually have it queued up here without their name. It's just cut off at the top there. And this is the history. So I usually sort it by oldest to newest. So I'm seeing the very first thing filed, which is the voluntary petition. And then scrolling through, you can see all of the filings. And as you'll see on this one, started in 2016, but if we scroll down to the bottom, this is a filing from just this past week. That was the day before last week's episode. And that was the hearing continued. It was another item that was filed. Now you'll see here that it's not, oh, I'm blocking you. Let me move over. You'll see here that this number 69 is black. It's not a link. All of the blue ones can be clicked into and then reviewed. And that's where you're going to spend 10 cents per page to download these documents. There is a cap of $3. So when you download a huge voluntary petition, your maximum is going to be $3, even if it's more than 30 pages long. In this case, the main thing we'd want to look at, and we're going to talk about this in the case study, because this is a case study we're going to be reviewing, is the voluntary petition. The voluntary petition will give you those schedules to show you the value of the property and the value of the liens. But then when we skim through all these other histories, there's some important things we want to look at. The amended Chapter 13 plan is important because that'll tell us how much the creditors are being allocated in the payments. And then these motions. So the most important motion to look for is what's called a motion for relief from stay. And there's one right here. Number 39 is a motion for relief from stay. Now, a stay is essentially a pause, a putting on hold. And that stay keeps any lien holder from pursuing a foreclosure while the bankruptcy is ongoing. So a borrower, if they're in a dire situation where they're potentially about to be foreclosed and they file a bankruptcy, they slow down everything. The courts cannot proceed with a foreclosure because a stay has been placed on this property. Now, a motion to relieve the stay is something that a lien holder will file to tell the courts that they wish to proceed with the foreclosure. And in this case, you'll see if you keep scrolling down a response on that motion. So we see some schedules, an amended plan, and I don't see a response from the motion, but normally you'll see a confirmation. Here's another motion for relief from stay, number 60. So that was potentially a different lien holder. And those motions, you might see them and be very scared at first as a lien holder, and especially a second lien holder thinking maybe the first lien has filed to relieve the motion and begin the foreclosure. But in most cases, those motions are for other assets. So a motion for relief from stay can be filed for a borrower's their automobile that was financed, or a different property, or it's not always the mortgage that's senior to you that's filing those motions. So definitely an important thing to take a look at to make sure that you are protected as a junior lien holder from a foreclosure event. Now, we'll get back into this in the case study coming up, but bankruptcy is there's a lot to talk about. So in a future episode, we might drill into just the voluntary petition and the schedules. But in this episode, I wanted to show you the history and the documents, as well as the case locator, because that's really the door into a borrower's bankruptcy situation. All right, let's get back over to the presentation. Let's see if the audio works this time. No, I don't know what's going on with that. I'll have to check it next time. Okay, so we've already went through all these services. I want to tease next week's episode, CoreLogic. We're going to be talking about their product called Credco and how you can use that as a tool for due diligence and loan analysis. But this week, we're talking about bankruptcy in the case studies, and I think that's what we got next. Oh no, assets for sale. We got to talk about loans we're selling because June offerings are pretty much wrapped up. At this point, we are moving into a new portfolio for July, but let's just pop over to the data tape here. Okay. So this is the available loans for sale following the past offering, and I'll pull myself off of there so you can see. We've sold now a good amount of loans, 8 loans for a total of $176,000, and we have a couple more under contract, and then we've got these 5 that are pending sale, but we're willing to accept backup bids. These 2 that have interested buyers, but the contracts have not been put in place yet, so those are still fair game. And then, of course, 17 loans that are available. Now, some of these loans were in other buyers' potential sales agreements, and they fell out of those contracts for whatever reason. One of the big ones that I found has been a reason for these borrowers to fade or remove offers was the fair market values. So you'll look over here in column J, these are the fair market values. And there we go. These values are, I believe, pretty accurate, but when you talk to a local realtor, and that is what I highly recommend as a note investor, to get someone who has boots on the ground to really understand these situations, you're going to find sometimes that a realtor doesn't have the same impression as the online desktop appraisals that we do for these to create these values. Now, these values are determined through AVMs, automated valuation models. We triangulate many different AVMs from different sources, like as simple as Zillow up to the GeoCore AVMs from CoreLogic, or the AVMs from DataTree. There's many other sources that we can use, but then at the end of the day, the best thing to do to review fair market values is to look at recently sold comps in the area. So that's been triangulated through a number of AVMs and then looking at the actual comps. Those loans are all available still, so we're open to offers there. And then we do have 2 loans that are closed as unsecured. So I thought I had scrubbed all the unsecured off of this list, but it turned out that a couple of these are no longer secured liens following our final due diligence before a couple of these had sold. These loans were kicked from the population and are no longer viable as secured debts. So this is what's available for sale now. I will send out a link to the vetted non-disclosure agreement signing investors so you guys can review the loans that are still available on this list. And you can also look at the pricing and kind of do some reverse engineering to understand how these prices were achieved. And we're actually going to go over a case study on this first one for $52,305 in just a minute. So stay tuned for that. While we're at the spreadsheets, I did have another spreadsheet pulled up here that I wanted to show you. This was the freebie from last week. And essentially what it is a multi-scenario, and I can put myself back on here. This is a template that we can use to create a couple different scenarios and calculate the internal rate of return and the values based on simple calculations. I actually, and I think Mia's in the group now. Thank you for joining us for the call, Mia. I see her chat. She said yay. Appreciate the enthusiasm. We worked together the other day on using this spreadsheet template to put some of the assets she was reviewing to purchase into this program to see what the internal rate of returns are. So if that's something that you're interested in, send me an email and I can help you calculate the expected returns based on either a refinance scenario or a paying to maturity scenario. And this chart is a good way to get a rough ballpark. But if you want to download this, this is linked in last week's episode. I'll link it in this week's episode as well, so you don't have to go back and see the disaster that was episode 5. Okay, let's get back to the presentation. Assets for sale, looked at the data tape, and case study time. All right, this is typically what we're all most excited for, because case studies are a really great way to build your confidence, to understand some of the potential pitfalls, and that's what we're going to talk about now, is a potential pitfall in bankruptcy. So as we've discussed, bankruptcy 13s can wipe out a junior lien. And that's a really important thing to understand, because not only does a bankruptcy wipe out the lien in some cases, but it also removes the personal liability of the borrower's obligation to a debt. So what that means is that even if a bankruptcy does not strip your lien, it still removes the personal liability, so that you cannot pursue the deficiency balance, which is an unsecured balance that's owed on a loan after a liquidation event like a foreclosure or a short sale. But it also keeps you from collecting on that loan through a judgment or any other type of unsecured collection strategies. Oh, thanks for the comment, Mia. She found it very helpful, and she made some bids the other day, so we're going to have to check in with her maybe in a future episode as an investor case study maybe. But moving on to this bankruptcy, so we've got a fair market value of about $120,000. The senior lien was $118,000. The homeowners association was owed $12,000, and at the end of the day, we're underwater $10,000. The balance is $27,925, and this is kind of a tricky situation, because we thought the fair market value is over $150,000. Actually, I'd expected the loan, this property, it's a condo, I expected it to be worth $170,000. So that would have put us in a much different situation. But it turns out that there was some damage to the interior of the property, and it resulted in a much lower fair market value than expected. So basically what happened here was the primary borrower was working out of the country, his family was at home, and they got behind on all of their liens, their homeowners association dues, their first lien, and their second lien. They were kind of in a position where filing a Chapter 13 bankruptcy in order to liquidate some of these assets was their best bet to get on financial footing. And I say liquidate, but Chapter 13 is the reorganization. So in this case, they were looking to find some ways to strip the liens, like our second lien, that were causing some undue financial burdens on them. So they put a property value in place of 118. They actually valued it less than the 120 that we conservatively calculated. And that was the first kind of battle with the borrower in the bankruptcy, is disputing their property value. So that dispute, it was not successful, because they had quotes from several contractors as to all of the work that was needed on the property. So at the end of the day, we're stuck with this $118,000 fair market value, which essentially wiped us out. Now, the subject lien, our investment here, will be stripped if the debt is discharged, if the bankruptcy is completed and makes it through the plan to discharge. However, we're still hanging on. It has not been discharged yet. So if we are able to get a dismissal at the end of the day, our lien is back on the table, and the property value is increased since 2016 when this was filed, quite a long time ago. So the majority of Chapter 13 bankruptcies are not discharged. They are dismissed, the opposite of a discharge. And estimates show that only about 1/3 of Chapter 13 plans are completed. So in this case, the lien is close to being wiped out and totally uncollectible, since the bankruptcy will remove the personal liability and strip the lien. But there is a chance of this being a salvageable deal. If we're able to get this dismissal, and there's nothing we can really do about it, the borrower is going to have to go through all of their plan payments, meet the court at the specified times, follow all the instructions. If they're able to do that, they'll be discharged, we'll be wiped. If they slip up and something happens, then that dismissal is our ticket to still having a secured debt. Property values have increased, equity has increased. So if this borrower were to refile bankruptcy, we would be in a much better position to have a secured lien here. So let's look at that voluntary petition, just so you can see what that schedule is that I've been telling you about. So this is the Schedule D, the creditors who have secured claims on the property. And it looks somewhat different in different courts, like in different jurisdictions, but You just scroll down through the voluntary petition until you see Schedule D, and then you know you've reached the good stuff that you want to really pay attention to. Now, the other things above this schedule are also important. Unsecured claims and borrower assets and other information that's very useful to understand. But if I'm reviewing a huge tape of a lot of different mortgage notes and I'm just extracting a couple salient pieces of data to then review at a high level and then go back to drill in further, I'm going to pull up the voluntary petition, or if the borrower filed the schedules late, you'll see that farther down in the history and documents. I'll open up those schedules or the voluntary petition and find this schedule, and then I'll pull out basically three things. I want to know the value of the property. In this case, you'll see it's $118,000 in column B. You'll also want to pull out the amount of the senior claim, which in this case is 2.2. Wells Fargo is the creditor for $118,868. And then I'll also want to pull the intention here, if the borrower is intending to strip us. And you'll see that in column C, in the 2.1, the very first secured claim, that's our debt, $27,925. And with that value and the other liens that we're going to see, the unsecured portion is entire balance, $27,925. The whole thing is wiped out. So in this situation, if that borrower gets discharged, we're going to be wiped in this chapter 13. So if you scroll down, you can see the next page has one more lien, and that's from the Homeowners Association for $12,000. And that lien is senior to our junior lien, and that means that they have actually $2,000 of secured balance in their Homeowners Association debt. So you'll see that on the right side, $10,000 is unsecured in column C, as a $12,000 balance. That does leave $2,000 of secured debt, which would need to be addressed in the plan. So this is right now a deal payoff not available, expected to be wiped. We expect to lose our money on this asset. This loan, I think, costs about $8,000, so it's not a small asset to lose out on. So we're fingers crossed that we have an opportunity here to resolve the debt with the borrower in a way that doesn't just strip our lien from the property. And I think that if the borrower is discharged, if the borrower is dismissed, we have a very good chance of coming to some agreement. But in this case, it's looking very dire. So I'll keep you guys posted on this as the bankruptcy unfolds, and we'll see if we get wiped or if we have a small win at the end of the day. Let's talk about another case study. So this is the one we did last week. I don't know why this is still here. One more case study. Okay, here's a brand new one. This is an investor loan sale that we just closed, and I mentioned this to you a minute ago. This was part of the June offering, and we were able to sell this loan for $52,305. That's 45% of the unpaid principal balance. So let's go through the high level. The fair market value is $431,000. The senior lien was $296,000. So that leaves $135,000 of equity, protecting our $116,000 balance. Now, in this case, the senior is current, and as we know in the first versus second liens debate, a second lien behind a performing first is a very good place to be, because the first lien is escrowing taxes and insurance. They're making sure that the borrower is keeping up with the property, and that their debt, which is double ours, triple almost, our debt at $296,000, they're making sure that that is protected and not at risk of being wiped out in any way. So as a junior lien holder here, the senior is blocking and tackling while being paid down every month, increasing our equity position. This is a relatively recent default. The last payment due date was in February of 2018. So they haven't been, actually the last pay date was in July of 2019. So in 2019, last year, they were catching up on their amortization schedule, paying their February payment. So they're now, they're paying their January payment in 2018 in July of last year. So they brought their next due date up to February of last year. And that means that it's in a position where it hasn't been neglected for very long. This is a relatively recent default, which is typically a good thing. Where are they now? Well, it does appear to be an owner-occupied property. The senior is current, which is great. Taxes are current. There's no contact with the borrower, though. We sent out our RESPA letters, which is your first hello to the borrower, telling the borrower that your servicing company is now managing their loan. It's been sold. And we didn't receive any response from the RESPA letter. There was a minimal outbound options campaign presented. So we sent a letter to the borrower that says, and this was good through a couple months ago, if you can pay us $104,000, we're going to forgive that 12 grand right off the top, or you can pay us $8,000 as a down payment and then start making a payment plan at $956 per month. The borrower did not respond to either of those options. We actually didn't hear from them at all. So that became a non-performing loan sale opportunity. My main client who was liquidating this asset is more of a deal-making company. We like to put our capital back to work to buy more assets. And if there's a low-hanging fruit, if there's a workout that's able to be achieved just from sending a RESPA letter and one options letter, that's great, but we're not pursuing legal and really going through the entire life cycle of a collection campaign. We spread the wealth, we pass those assets on to investors who are either in the local markets or have more of a specialized collection approach, which does typically include legal. In this case, the next step would probably be to file a demand letter to let that borrower know that this debt needs to be addressed. And because of the amount of equity, you're super protected on this deal. So there's no collection campaign traction. We had to sell it. And there were several offers at the strike price. We were asking $52,305, asking 45% of the unpaid principal balance. We got several offers at that number. The awarded buyer, though, was the most responsive. He was a proven closer. We've done business before. And they were able to complete their due diligence quickly. So this was sold as a one-off. Now, we're going to talk a little bit later about diversification and how important it is to have a portfolio of assets that protects your investment. When you've got a high equity loan like this and you've got other loans in your portfolio already, a one-off isn't the worst decision here because you've got plenty of equity protecting your situation, and if you've got other loans in your portfolio, you've got other activity ongoing, other irons in the fire. But in this case, it was sold as a one-off, and it was sold for 45 cents on the dollar. So we'll see how this pans out if I have another conversation with this investor and see if they're able to achieve a workout. I think because of the equity and the fact that we did not go through the legal process yet, I think that this borrower will come to the table pretty quickly once there's some legal notice filed to let them know that the lender is serious and this debt needs to be addressed very soon. And of course, if they don't want to stay in the property, this isn't even a short sale. This is a full loan payoff if they're able to sell the property. All right, so I think we're on to giveaways, and this week is a little special. Oh, I already showed you the freebie. I'll put that in the comments below. That's the internal rate of return and basic cash-on-cash return calculator, so you can use it to define some scenarios for cash flowing assets using Excel. So you can download that spreadsheet below. And giveaways. Okay, so giveaways are a fun part of the call now because we're not giving away anything stupid like a $1 Amazon gift card. We're giving away a 15-minute consultation. My time is valued at $160 an hour. On my website, you can book my time, $40 for a 15-minute consultation. So a free consultation here. It's a big win if you are getting into this business and want to pick my brain. We can talk about everything, really. We can talk about business in general, entrepreneurial kind of approaches to different aspects of your life, or notes specifically. So you got to subscribe to the channel. You got to like this video. You got to make a comment. Now, once you have that under your belt, I need your information. So either send me an email or send your details at FIXnotes.com/buy. And then I will be able to reach out to you and set up a call. So we did our first call this week, and I was very excited to speak with Shanisha. And I was especially excited because not only has she been commenting on all of our videos and asking some really great attentive questions, but she also read through the course. And I got a notification the other day that I had a new comment, and Shanisha was doing a little proofreading. And she actually noticed a spot where I had a... I think I said yours instead of your, or something like that. It was a simple, like, deleting one letter, and she commented and highlighted that, and that attention to detail I thought was really important, and she's going to make a great note investor. She's actually a realtor in Illinois, and that's a really great place to be getting into this business, already having some experience in real estate in general. So we had a 30-minute call, actually, and talked about a bunch of stuff. Let me see what her questions were so we can get a little bit of detail here. I'm going to just kind of go over the high level here as to what these the answers to these questions were, and then we're going to show one quick clip from our call that we can kind of expand on a little bit. But her questions were about credit reports and permissible use. And my answer to that was, yes, we have permissible use as note investors, but you want to leverage the seller's credit report since they are the asset owner with the beneficial interest. You want to make sure you either have permission from the seller because you have a beneficial interest as an investor doing your due diligence, or you want to use the credit reports they've already pulled. Make sure they are soft credit pulls and not hard inquiries because that can negatively affect the borrower's credit. She also asked, is it best to buy a small pool to diversify? Of course, it's better to buy a small pool than a one-off. And I would recommend junior liens especially to diversify with less capital. She asked about, can note investors make good income good enough to leave their jobs? Or is it best to have a note business providing some services to other investors to supplement your note income? Now, my answer to that question, and this will segue into the clip we're going to show, is that it is very important to build up some level of expertise in a service providing role in this business. And for many reasons. The most important is to ramp up your confidence level, and that's what we're going to hear in this clip. By being a service provider, you're essentially using other people's money to learn the business, either by being an intern and learning from somebody who's got an active trade desk or an active resolutions department. You can learn from them that way, or if you're a little more entrepreneurial, by developing your own service. So since Shanisha's a realtor, she's got some internal information. She knows the real estate market in her area. She can use that as a service point to give investors boots on the ground opinion on the properties that secure their debts that they're attempting to buy or have already bought. So I thought that was a great way for her to get into this business. And let's go over to this next slide here. Oh, I even had a slide with all of the I had a slide with all of the detail here with all of Shanisha's questions. So let's just show it so you guys can actually see credit reports we talked about, small pools or one-offs. Can note investors make good income? And then I guess we didn't talk about one more, did we? The CRM, leveraging Podio. So yeah, I wanted to talk about this quickly. Podio is something that I use to manage my note investments. Some people just use Excel to manage a large portfolio of assets, but I find the automations using GlobalFlow, which is an add-on to Podio, and Podio combined is super powerful for this business and something that I want to develop as a product maybe going forward, or some type of service that I can offer to you to customize your Podio systems to be successful note investing machines. So that's going to be something we talk about going forward. I don't exactly have a game plan to monetize that or to offer it yet, but we'll talk more about this in the future. And if you are interested in using Podio for your own note business, I would encourage you to get started on it because it's free to start playing around and understanding how the system works. And then reach out to me if you have an idea of taking it to the next level. All right, let's meet Shanisha real quick. And we got permission from her to share some of our calls. So hope she approves of the clip we have. She's very cute. All right. Oh no, I hope you're getting the audio. All right, for some reason, I don't know what is wrong with our audio here. Give me one sec. Let's see if document. Yeah, this is a bummer because this is a good clip. All right, so on the fly here, I think I've been stumped. For some reason, none of our background music or our audio from our second computer in the presentation mode came through. It's a real bummer. I'll have to work that out for a future episode. But Shanisha basically explained that her biggest hurdle going forward is her confidence level. And she's really looking forward to making her first purchase. And that's the goal, to buy your first note, because that gives you that next level of confidence actually achieving it. And in my opinion, doing is the best way to learn. And she really is on the right track, I think. She's learning from our course. She's reviewing assets from multiple sellers. And at the end of the day, it's about the confidence to pull the trigger. So my advice to her was try to insert yourself into someone else's sales process or their resolution process. Learn from someone else's money with their money on the line to give yourself a boost of confidence without risking your own capital right away. Of course, if you can buy your first asset without doing that, that's super brave, very commendable. And I encourage you to at least review that and make sure that's an option for you, because that's going to be how you learn due diligence, by analyzing assets that you're eventually planning on buying with your own money. But whatever you can do to network, find other people in the industry, and then add value in whatever way you find is most suitable for your own skill set, that's going to give you such a higher level of confidence and give you a foot in the door with some of the industry participants to maybe partner with them in other ways going forward. So that was a really great call with Shanisha. We'll have another call coming up next week with another investor. We may start doing live calls, but with my track record of technical difficulties, we'll probably keep them pre-recorded for the short term. All right, this was an awesome show. Thank you guys so much for joining us. I'm going to add that link for the freebie in the description below. Please like this video, subscribe to the channel, and comment with some questions that you'd like me to cover, and I may choose you to offer this next 15-minute consultation. So unfortunately, our closing is going to be maybe silent because my audio is not working right, but we're going to run through the show one more time. Let's put that up. What is with that, man? I don't know what's with the audio. I really apologize, guys. And we also didn't do something else this week, and we've been lacking on that as well, and that's our multi-angle view with the bird watching cam. Don't think I forgot it. Well, I did forget it, but here it is. We've got the lower bird feeder swinging around. We probably just missed a woodpecker over there. And then our upper feeder, nothing happening today. But we'll definitely, in future episodes, continue to refine this format of the show. And next week we'll have audio, we'll have our background music, we'll have our presentation volume, and hopefully find a cute little cardinal or something snacking on some seeds. Thank you guys so much for joining us. It's always a pleasure. I really appreciate you guys hanging out with me, giving me comments in the description, and being an engaged participant here. Thank you so much. Have a great day, everybody.